Welcome, dear friends and investors, to yet another month of views on markets and investing. So, what will we cover this month? Well, now that the results for Q4 and the whole of FY25 is out, we will look at the numbers and the story behind the numbers and decode what messages are hidden inside these numbers. Along with earnings, we will also look at the Capex trends. And this time, we will not just talk about government Capex, which you all know has been driving the growth in the economy, but we will also talk about private Capex, which has been an area of great interest and debate across economists and investors. So let's just dive straight into the earnings picture. And what we will do is we will look at both the Q4 earnings as well as the whole of FY25 and how each of the segments have performed and what are the takeaways from these earnings. So let's look at Q4 first. If we look at the fourth quarter earnings ending March 25, what we see is that the Nifty companies actually saw a degrowth of 2% in earnings, which was quite disappointing. However, if we look at a more broader profile of Nifty 500, then earnings have grown at 7%. But what is interesting is that the standout segment was the Nifty midcap companies. So the top 150 midcap companies actually delivered a very strong 29% earnings growth. If we look at the full year, well, the picture is very similar. For the full 24-25 financial year, the large caps actually delivered very disappointed earnings, and therefore Nifty earnings grew by only 3%. The broader markets, that is the top 500 companies, the aggregate earnings were up only 5%. And again here, it was the mid-cap companies, the top 150 mid-cap companies, which grew earnings at 19%. So there's a huge differential between the mid-cap companies and the larger companies. And the Nifty small cap also broadly grew in line with the bigger average, which is it grew at about 6%. So really, what it tells us is that it was, from an earnings perspective, a very subpar year. And earnings did not even grow in double digits. One of the interesting ways of also looking at earnings over a slightly longer time frame is that we have compared the earnings of the broader markets with nominal GDP. Now, why we've done that? Usually, we would see a trend where earnings for the broader markets tend to do better than nominal GDP, because GDP is a combination of all the value added. It is a representation of how the economy has done. And usually, your top 500 companies, which are more efficient, should obviously grow faster than nominal GDP. And if we were to look at this broad trend over the last 6 years, and the reason why we've taken 6 years is because we wanted to include outlier years like COVID, the Russia-Ukraine war, and there are several events that have happened in the last 6 years. And what we see is that of the last 6 years, there were 3 years in which earnings grew less than nominal GDP. And usually those are the outlier years, right? That is not usually the norm. It's usually an exception to the norm. So if we look at March 19, nominal GDP grew at 11, but NSE 500 earnings grew at 21%. March 20 was an outlier year because it was the year of COVID. And while nominal GDP grew at 6%, the earnings grew by negative 9%. March 21, nominal GDP was minus 1%, obviously because there was a contraction because of COVID, but earnings grew by 47%. March 22, 19% nominal GDP growth, and NSE 500 earnings growth was up 40%. March 23 was again an outlier year. If you remember, we had the Russia-Ukraine war, which broke out in 22, and hence the financial year 22-23, earnings got impacted, and we've spoken about this in the past. While nominal GDP grew at 14%, earnings only grew at 10%, so lower than nominal GDP. But in 24, earnings bounced back very strongly. So while nominal GDP grew by 12%, earnings were up 33%. And March 25 was again one of those exceptional years where earnings growth was only 5%, while nominal GDP grew at 10%. And that was largely due to the election-related slowdown in the economy and the fact that Capex also slowed down in the second half of the year. So I believe that what we've seen in 24-25 was really an exception. And while the RBI expects the nominal GDP in 26 to be slightly above 10%, we are very hopeful that earnings this year, after a very tepid growth last year, should bounce back to double digits. It will be very interesting to see where finally earnings land. But if we were to look at the historical trend, then I think that usually after a bad year, you do have a fairly good bounce back in earnings, and that should bode significantly well for the markets as well, right? Finally, the question therefore is that the reason why we speak a lot about earnings is because, as they say, that markets are a slave of earnings. And while in the short run there can be always disruptions, in the long run, by and large, markets have tended to move in line with earnings. And that's exactly the situation when you look at the picture from FY19 to FY25. In these 6 years, the top 500 companies, we've seen a revenue CAGR of 10%, net profit CAGR of 19%, which means that earnings have compounded over the last 6 years at 19%. And this is despite the fact that in this 6 years, we've seen 1 year of COVID, then a year of disruption because of the Russia-Ukraine war. And then again, last year we saw a slowdown which was related to elections. But all of this is being captured in this 6-year period. And what's interesting is that the markets have compounded almost broadly in line with what the profits have compounded. So, profits went up from 5 trillion rupees as of FY19, that is 5 lakh crores. And in FY25, the top 500 companies had an aggregate PAT of 15 trillion rupees or 15 lakh crores, which is a compounding of 19%. And therefore, if you look at the total market cap of the top 500 companies as of FY19, it was 132 lakh crores. That's went up to approximately 400 lakh crores, which is a compounding of 21%. So yes, we've seen a little bit of a re-rating in the PE multiple, but the story is very clear. Profits compound at 19%, the markets compounded at 21%. And therefore, the big takeaway from this is that we all get caught up in a lot of narratives. There is war, there is COVID, there is always something which is happening, and we tend to attribute market movements to many of these events and narratives. But the reality, dear friends, is that in the long run, markets tend to reflect earnings growth. And therefore, what gives us the confidence that whenever earnings growth are strong, we believe that there is a foundation to this market, and all other narratives like there's too much liquidity, there's money chasing, there is, war, tariffs, all of those are probably more short-term events. Eventually, in the long run, it's just profits and cash flows which determine value creation in the market. Now that we have comprehensively spoken about earnings, let's get to another very important trend, and that is of Capex spending. As you all know, friends, that we have been very consistent that in the economic and the market cycle post-COVID, a large part of the growth and the performance of several sectors were largely dependent on the capital investment cycle. And a large part of that thrust was due to the central government Capex and the growth that we've seen over the last 4 years. As you all know, we have talked over the last several months that we did see a significant slowdown in Capex last year because of elections, both the central elections and the state elections. And we definitely saw a slowdown in Capex, which in turn, as we discussed earlier, also led to a slowdown in earnings. And even when the budget was presented early this year and the revised number of Capex was reduced from 11.2 trillion to 10.2 trillion, there was still a very healthy dose of skepticism within most investors and strategists that whether even this reduced 10.2 trillion would be executed upon. However, as the numbers now show very clearly that the government did press the accelerator in the last quarter of the year, and especially in the month of March, the Capex number stood at a staggering 2.4 trillion. And finally, the government did end up spending the full 10.2 trillion that it had budgeted for in the revised numbers. And in the first 2 months of this year, we continue to see that trend. So what we have seen is that when we compare the first 2 months, that is April and May, going back even 2 years, so April and May 2023, the Capex in these 2 months aggregated to almost 1.68 trillion. That number last year, which is April and May 2024, had fallen to 1.44 trillion. So that was roughly 14% lower on a YOY basis. However, that number this year in April and May 2025 is 2.2 trillion, which is a 54% growth over the same 2 months of last year. And as we had said in our previous communication, we do believe that this government will finally end up spending the new 11.2 trillion in the current year. And if it ends up doing that, because we had a low base last year, you will have a very strong growth in central Capex, especially from now up until December. And we have seen that with order books coming back, the capital investment cycle has really bounced back on the back of very strong central government Capex. However, this time we also looked at private Capex. And what we did was that we looked at the trend of the Capex spending by all the listed companies on the stock exchange. And that gives you a fairly good understanding of what's happening to private Capex. As you all know, there has been a lot of debate that while the central government is doing Capex, the private sector is not doing Capex. However, we believe that this perception is completely flawed. And if you look at the data that we've presented, what you will see is a very interesting trend. As you know, a very strong Capex cycle had started post the TMT bust in 2000. And from 2001 right up until 2011, Capex galloped and it reached a peak of almost 6 trillion rupees a year. So all the listed companies put together in 2011 spent about 6 lakh crores on Capex. And as you can see, right from 2011 right up until 2022, so almost a decade plus, that Capex number kept oscillating between 5 to 6 trillion every year. So it was almost stagnant and range bound between 5 to 6 trillion every year for almost a decade. And now we are starting to see a significant improvement in the Capex by all the listed companies. And for the year that has just gone by, we have now broken out and the total Capex by all the listed companies has improved from 6 trillion rupees to 11 trillion rupees. And therefore, the perception that only the government is spending is not true. We believe that in the last 2 years, on the back of delevered balance sheets, very strong cash flows, the private sector has also joined the party. If you now look at all three constituents who spend on Capex, right? So we talked about the central government, we talked about the listed companies put together, and then there is a third constituent, which is the states. So this Capex happens at 3 levels. The state governments do Capex, the central government does Capex, and then all the listed private and public sector companies do Capex. And when we look at that number, again, it tells you the same story, that on an aggregate basis, by the end of 21, the Capex was almost about 14 trillion rupees. And as of end of FY25, that number has gone up to almost 29 trillion rupees. So if you add up state plus center plus the listed companies, we've almost seen a more than doubling of Capex between FY21 and FY25. However, what is most interesting is that the year that just went by was the first year where the aggregate Capex by all the listed companies is now higher than the government Capex, right? So as we all know that government Capex was about 10 trillion, the total aggregate Capex of all listed companies in FY25 was 11 trillion. So this is the first year in many years that all the listed companies together are now doing Capex in aggregate of or higher than what the central government Capex is. And then We have another interesting data on research that was done by ISEC, which is that they calculated that how many companies are doing capex in excess of US dollar 100 million, right? And if we plot that trend right from 2001 up to 2025, what we see is very interesting. The last time this number peaked was in 2011, when companies in aggregate put together did a capex of 131 billion. And almost after 14 years, we've come back to that 130 billion number. This time, it is 157 companies which have done capex in excess of $100 million each, totaling to 130 billion. So, in other words, it has taken us, as they say in Ramayana, there was a 14 saal ka vanvas, right? After 14 years, we are seeing that the private sector capex is now coming back to the levels that we saw in 2010-11. And therefore, we believe that India's capex story is back. And this time, while it was initially helped and started by the central government capex, we are now starting to see the early signs of a breakout in private capex as well. And therefore, this is also reflective in how sector leadership has again changed. As you all know, that a lot of the manufacturing, capital goods, defense, infrastructure stocks went into a deep correction after the election results of June 4. We saw that many of these sectors and companies corrected. So if we look at the performance of the various sector indices, it actually tells you a very interesting story. So we've looked at the returns from 3rd June to the index lows, and various sectors achieved their lows somewhere between February to April of this year. If we, for example, look at the Nifty Defense Index, it corrected from June 3 to the lows that it achieved on 18th February 25. The index was down by 26%. But from the lows to the end of June, the index has recovered 73%. So it fell 26%, but it's up 73. The real estate index similarly fell by 28%, and it created a low in April and has bounced back 27%. The Nifty Infrastructure Index fell by 16%, but is up 23%. The Nifty Manufacturing Index was down 14%, but is now up 20% from the lows. The BSE Capital Goods Index, which fell by 16% and made a low on 25th February 25, from that low, it's now up by 31%. So it fell 16% and up 31%. And if you look at the Nifty India Consumption Index, because the consumer stocks really didn't fall much, but they were down -4 and they are up 17. So while the consumer index has also done well, what you really see is that defense, real estate, infrastructure, manufacturing, capital goods, they all corrected substantially and have now bounced back significantly from their lows. And therefore, again, very consistent with what we have been saying for the last several quarters now, is that we do believe that the leadership in this market continues to be driven by the investment cycle. However, we do believe that with a good monsoon, with the tax cuts, and the kind of liquidity that the RBI has infused in the economy, we do believe that consumption should also revive over the next few quarters. But we still believe that the strong leadership in this market will continue, like we've seen, especially post 2022, will continue to be driven by manufacturing, cap goods, and largely the sectors which are related to the investment cycle. With that, we end this month. Until next month. Thank you.